What's left over after you pay for the direct cost of producing that widget is what's called your gross profit. And that gross profit expressed as a percent of revenue is called your gross profit margin. We've had clients who have done this, and within 2 or 3 years, they're making 300-400% more profit because they're focusing their energies on the right types of clients, the right types of customers. One way to raise pricing is to reduce services, but keep the price that they're paying the same. If they're used to paying, $12,000 a month and they can't pay more than that budget-wise, great, reduce the scope of work.
Maui Mastermind presents the Business Coach Podcast, answering your questions and providing real actionable insights for building a better, stronger, more profitable business without sacrificing your time, life, or freedom anymore.
Well, welcome to another edition of The Business Coach. I'm your host, David Finkel. And in this particular episode, I want to talk about what I think is probably the least leveraged, least understood, and really ignored financial KPI that's out there. And I think it's so useful. I use it every day with clients that we coach to help them increase profitability, to make decisions like which products should we be focusing on, or which marketplaces actually bring us the most profit, or hey, if I look at these 7 people who play a production role for us, how can I learn or look at a way to compare person 1 to person 2 to person 3 that's an apples to apples comparison in terms of the amount of profit they generate for the company? And there's a simple KPI that is at the heart of all those types of calculations. It lets you decide which customers should you no longer do business with and which should you aggressively court, we'll call it that way. A little bit ago, I was teaching a workshop for our business coaching clients. We had, I don't know what it was, 100, 120 business leaders that were there with us in Salt Lake City, and we were going through the financial pillar of their company. How do you manage cash flow? How do you protect profitability? How do you really understand the stories of your own financials? And how do you set up good financial controls as you scale? And we were doing all of that. But one part of the conversation that I found really interesting was this idea of how can you intelligently manage your own business by using certain KPIs. And one of the most important KPIs by far is in fact this KPI we call ... your gross profit margin. I want to talk about what your gross profit margin is, how you can use it, where so many business owners ignore it, and why they miss out on easy opportunities to make more money, to serve better with less work and effort. First of all, let's just do a few basics if we can. I think it's important that we all know where we stand with these things. So first of all, if you imagine money comes into your business, and we'll call this money that comes in revenue, right? Total sales. So as revenue comes in, we subtract off from there something that's called COGS. It stands for cost of goods sold. Now, that number, that term originally came back when businesses that did the accounting were thinking about it as hard physical stuff, products. Like if I'm going to build a widget, I've got to buy raw materials for the widget. I have labor costs to build and make that and produce that widget. I might have equipment costs for that widget. And all that becomes cost of goods sold. And what's left over after you pay for the direct cost of producing that widget is what's called your gross profit. And that gross profit expressed as a percent of revenue is called your gross profit margin. And as you go through this here, this number, gross profit, is such a valuable number, especially when you get to this one here, your gross profit margin. We're going to talk about how you can sing and dance this in your business to make more profit by making smarter choices of where to invest and where to not invest. Of course, just to finish the equation off, now we take our other expenses, our general and overhead expenses, our marketing costs, our other variable and fixed costs. And what we're left over with when all that's said and done is we have something we call our operating profit. In QuickBooks, if you're using that, they're going to call it your net income automatically. In a more sophisticated accounting software, you'll have some choices about that. But basically, your operating profit is your pre-tax profit before tax from the actual operation of your business. It does not include things like one-time things like, oh, we have a big machine and we sold it and we made a couple $100,000 on the sale of that machine. Well, that would be part of your net income, but would not be part of your operating profit. But to simplify it, we're going to use operating profit. For most companies under 20, 25 million a year in sales, that's a pretty good measurement. And we can also express your operating profit. That also becomes a margin as well, called your operating profit margin. But we're going to spend most of the time here talking about this thing called your gross profit margin, and it's so useful. So first of all, think about what this number is. If I sell something, let's make two different ways. Let's say I sell product A or service A and service B. It really doesn't matter if it's a product or a service, the same exact concepts apply. And let's say I sell one of these for, I'm going to make up my number to make it easy, $10,000, and the other one I sell for $20,000, right? So they're different products, different services. It's hard to compare. The unsophisticated business owner says, well, hey, product A I sell for 10,000 more, I sell it for 20,000, it must be better. But that might not be true. That really might not be true. So for example, if product A cost you $2,000 of cost of goods sold, in other words, to produce service B cost you $2,000, and you sell it for $10,000, how much gross profit, how much profit have you made before you have your other below the line expenses, things like administrative costs, accounting costs, marketing costs, other general overhead, etc. So you're going to have an $8,000 gross profit. Now that $8,000 as a percent of your total sale of $10,000 for the sale of that service means you have on that particular service line or that product line, you have an 80% gross profit margin. Now that's a useful number. That's a really rich gross profit margin for most businesses, especially if it's a product-based business, but even in a service business. Why? I have clients who would love that kind of number coming in. Let's say you now sell service A. Service A is much more expensive, $20,000, costs twice as much. Let's say though that it takes you $12,000 to service and create the service there. You have more expensive staffing and more expensive equipment in that service offering. What that means is when you're left, you had the $20,000 that you got in gross revenue, and you paid $12,000 for its cost of goods sold, so you were left with an $8,000 of gross profit. Notice the gross profit raw is the same amount of gross profit. But if I look at it as a margin, $8,000 as a percentage says you have a gross of $20,000 as a 40% gross profit margin. All things being equal, product or service B has twice as much gross profit as product or service A. By itself, that doesn't tell you which is better, but it does give a strong indication of it. So now, all things being equal, if I could sell $1 million of either service B or $1 million of service A, which would you want? Of course, you'd want to sell $1 million of service B. Why? Because by selling $1 million of service B, you're going to have an $800,000 gross profit, versus if I sold that same $1 million of service A, I'm going to have half of that, only $400,000 of gross profit when I compare the two. To our Business Coach podcast listeners and viewers, I wanted to just for a moment here pause and tell you about a brand new tool that we've taken about 1.5 years to create. It's called the Ultimate Business Owner's Toolkit. And in there you'll find 6 of the best, most popular tools that we've created for use with our business coaching clients to help you scale your company, to make it more profitable, and quite frankly, to make it more of a joy to own. All the tools are right there with really short and simple 5 to 10 minute introductory teaching videos that show you exactly how to use those tools to get them producing for you and for your company today. So for information about more of that, you can see the show notes, or you can go to mauimastermind.com and go to the resources section and get your copy of that toolkit and get access to that now. With that said, let's get back into the podcast. So gross profit, what it does is it lets you make an apples to apples comparison. In our example here, the apples to apples comparison was between a product A and a product B, a service A and a service B. But we could also do that by locations. For example, I remember one of the medical groups we were working with had 3 locations. And when we looked at their gross profit by location, one of the locations was losing them money because the cost of operating that was more. Here's another example. A construction person says, hey, I have a general contracting business. We do home remodels. We do a few custom builds. We also have a part of our business that does outdoor living spaces. Oh, and we also do some of handyman work just to kind of keep our crews busy. When I look at those four, probably, this is based on actual talking to clients that I have that are doing this, the outdoor living space might be a much higher gross profit margin than the general contracting or the remodeling work that they do. So all things being equal, when I know which of my products or services has a higher gross profit margin, I tilt or focus more of my marketing and sales energy to find and sell more of those types of jobs, more of that type of work. And when I do that, here's the beautiful part. The same production capacity aligned to my most profitable product lines, service lines, locations, etc., might mean for my business that I make 10% more, 20% more, 50% more. We've had clients who have done this, and within 2 or 3 years, they're making 300-400% more profit because they're focusing their energies on the right types of clients, the right types of customers. And I'll give one more example for it. So imagine this, A, B, and C. Okay, we have an IT company, a technology company that does a lot of consulting work. And they were looking at what was going on for their profitability, and their gross profit margin was holistically fairly low, and they were upset with that. And so one of the things we had them do is we said, okay, take all your clients and put them into 3 different categories based on gross profit margin. Your highest margin clients are going to go into bucket A. Your moderately profitable clients, gross profit, are going to go into bucket B. And those that are at a very low gross profit margin or a break-even gross profit margin or even a negative gross profit margin, put them as category C. And when they did this, they found that they had a percentage of their clients that were in this category C where they were effectively taking up anywhere from 30 to 40% of their capacity to serve clients that were effectively making them no profit, right? And they said, well, David, we have to have that because I need a certain amount of revenue to keep the business going. And I said to him, well, look at this. Now, you have certain clients, especially your newer clients, that you're making a really healthy gross profit margin. And you have some other clients that you're making a reasonable gross profit margin. But 30 to 40% of your capacity is tied up in these people that you're making no profit from. So if we can minimize the energy here, maybe you can't do it all at once. Maybe we're going to break this 30 to 40% into 3 groups, and you're going to take 1/3 of them, and in the next 30 days, you're going to raise their pricing such that they become at least a category B or if not a category A client. One way to raise pricing is to reduce services, but keep the price that they're paying the same. If they're used to paying, $12,000 a month and they can't pay more than that budget-wise, great. Reduce the scope of work so that $12,000 is the equivalent of what you might charge somebody else $15,000 or $18,000, right? You have to find your smart ways of doing it. And by doing it 1/3 at a time, you're going to find that some of those people are going to do that. You're going to turn a client that was not profitable into a profitable client, and some of those clients are going to leave. And maybe 3 months later, I do that to the next wave. And in the meantime, I can replace the clients that I lost with more of my A bucket clients, my clients that are most profitable. This is a rational, smart way of running your business. But to do that, you really have to have a firm handle on what does it mean to have your gross profit nailed. Now, you might ask, well, David, I can understand how globally, I can take my financials and I can look at, here's my total revenue. And if I subtract off my direct cost of producing my product or service, I can see how I get gross profit. But how would I possibly know that per client or per location or per product line or per service line? And here's how you do that. The good news is you don't have to do a lot of math. This is all something that your accounting software can absolutely do for you, essentially automatically once it's been set up properly. When I look at the clients that we have, probably by a large margin, 85, 90% or more of our clients are using QuickBooks Enterprise or QuickBooks Online, right? QuickBooks is by far, for companies under 50 million, the dominant player for the small business market. Somewhere between about the $20 million and the $100 million level, I've got clients that now are no longer using QuickBooks, that they've outgrown that and they're now using things like Sage or NetSuite or something else. Or maybe their accounting is in their ERP, their Enterprise Resource Program, basically the software that runs their business. Many of these in specific industries will have an accounting module that already is automatically built in. But at least 85, if not 90% of our clients are QuickBooks Online. To that end, you can just set up your key breakdown, in this case, product line or service line. You can set that up as a class inside of QuickBooks, and you can pull a P&L by class and see what's my gross profit per service line or product line, or by location can be set up as a class. It's using and leveraging the accounting software to do that. If you're not sure how to do that, or that's not something you've done, talk with your accountant, talk with your controller. They should know how to do that part. If you're listening to this and you're a client of ours, talk with your Maui coach. My gosh, let your business coach take the heavy lifting for how you go about this and just to explain this more in detail. So when I can see my gross profit margin by key breakdowns, now I can make smarter choices around that. And so we were spending some time on this on the weekend, helping people make some of these choices or some of these decisions. So the first thing that your gross profit margin really does is it helps you know where to put energy in on, what part of your business is more or less profitable. The second thing that it does is it lets you do something that we'll call benchmarking. It lets you compare your company against your industry. So if you're running, for example, a services company, and in your industry people are typically running at about a 50-55% gross profit margin, and you're at a number that's higher or lower, you're now knowing how you're doing relative to your peers. That's a really useful number, a way of looking at that. The last place that I'll tell you is that gross profit margin is a fantastic leading indicator. It's a fancy way of saying it's a warning light that something good or bad is about to happen. If you have historically kept a 60% gross profit margin, and all of a sudden it dips down and goes down to 51% gross profit margin, or even a 54% gross profit margin, that becomes a warning light that says, I don't know if you ever remember that old TV show Lost in Space. Danger, Will Robbins, danger, right? It tells you something is dangerous going on in your business. And now you can look at what's causing that. Did somehow you have an issue with, for example, the pricing, that you had an erosion of the prices you're charging, or did you have some kind of production inefficiency happen? One of the construction companies we work with, they had a lot of guys having to go back to do rework, and that rework was costing them tens of thousands of dollars every month by sending crews back out to do work that was already done before. They saw it show up in their gross profit margin before they spotted it in the actual activity. The gross profit margin said danger, and then they went and figured out what was going on, and then they fixed what was going on. Another thing that might be going on, and here's probably the most important one, is scope creep. Please, if you have any kind of service business and your gross profit margin is not where you want it to be, I can almost guarantee you that you likely have a scope creep issue. You're selling services that include A and B, and then all of a sudden you're finding out that because the customer or the client asks for C along the way, your staff is giving it to them, and of course you're not charging for it, so your gross profit margin is hurt. I remember several months ago I did a detailed episode about the 7 ways that scope creep you can protect yourself from scope creep. Go back into the archives of the podcast and find that episode. I think you'll find that 20-30 minutes will be extremely important for you from your profitability standpoint. Last thing I want to talk about here is what actually goes into your cost of goods sold. Like what goes into your cost of goods sold depending on the type of business you have. So I'm going to give a couple different case uses for this because people ask all the time. So we're going to talk about a product-based business. We're going to talk about, we'll call it a professional services firm. We're going to talk about a construction or blue-collar services firm. And we'll give all 3 case studies from that part. So what's in cost of goods sold? So cost of goods sold is all the expenses that you have for the direct production of your product or your service. Every business has cost of goods sold. So for a product-based business that manufactures something, my widget maker, we have a client who, for example, makes industrial control parts. They make miniature brains that get put onto automated factories to make the automated factories run smart. That's what they do. So their cost of goods sold would include the actual raw parts that they buy, the computer chips that they buy, would include the cost of labor for the assembly, the cost of the shipping of things over from Taiwan or overseas to the United States. It would include all those factors. If you're buying product to resell later on, where you're not making it, but you're just getting it and then reselling it, for example, a wholesale type of business, one of our clients does that in communications, telecommunications equipment. Great. They buy $1 million worth of stuff this month. They sell it for $1.4 million this month. That gross profit for them is going to be that 1.4 million of revenue minus the 1 million cost of what it costs them to buy and pay for the shipping to get and to pay for the shipping to send. So they made a $400,000 gross profit as an example that month for that company. Now, a professional service firm might be different, like take a medical place. So, what are the cost of goods sold would include your doctors and your mid-level clinical staff, the ones that are doing the medical service. In a CPA firm, it would include your CPAs and the people actually doing the tax work, for example, enrolled agents or bookkeeping. It would also include physical things that need to be there. If like a medical office might have medicines or other types of therapeutics that get used up as part of the treatments or the services. Generally, you're not going to put a proportionate amount of the overhead of the business. Oh, David, if I have a 15,000 square foot of medical space in our building, of which 10,000 is used by my treatment people and 5,000 is used by my administrative people, rarely will you see in a medical practice that they'll attribute the part of that overhead to the cost of goods sold. They just don't do it commonly. So in your industry, if it's a common thing, by all means do it. But you want your financials to line up with what your industry does so that you can benchmark. Plus, should you ever want to sell the business at some point down the road, it will also allow you to do that more effectively because your financials will look like someone else's financials for that. All right, that was a lot here today. One more type of business we said, construction. Labor and raw materials are the biggest construction costs for cost of goods sold, and possibly equipment costs. Like, for example, we needed to bring in a crane or a big earth mover or something, and we had to lease that or rent that for this project. That's going to be your cost of goods sold there. So here's my action coaching for you. I want you to do two things. Number one, I want you to look at your own financials. Did you set them up the right way so your cost of goods sold is clean, clear, and easy to see? Number two, what's the most important breakdown in your company? Is it by product or service line, or by location, or by type of customer, or by the client, him or herself, or their self? And I want you to set up your financials so that you can see your gross profit margin by that key breakdown. And if you do that, it'll be so much easier for you to make smart decisions. Whenever we're coaching a client, we're always looking at, or always regularly looking at their gross profit based on some key breakdown and looking at that as a gross profit, as a margin, as a percent of revenue. It's such an easy way to get real good X-ray vision about where is the most profitable place to focus on and where is a business not making as much money that they should stay away from, phase out, diversify away to reinvest the energy into more profitable places for the business. I appreciate you spending the time with me here on The Business Coach for this episode. I hope you took something of value from it. And if ever we can be helpful for you, I look forward to when our paths cross in person. Thank you so much. Bye, everybody.